Well, the markets certainly liked U.S. inflation data, at least if you look at the NASDAQ today. But everything basically takes the cue from numbers that were basically in line with expectations to say event risk is out of the way, power them higher. That's the story that we come into the second half of the week with here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And we turn our attention across the Atlantic as we proceed throughout the week because one of the most interesting pockets outside of heady stock markets has been the story that the CPI numbers really subsume at their core. And that is, of course, the critical narrative for markets basically the entire year, but for the US presidential election, the outlook for the Fed and the implications of what that means for markets. But of course, as with anything in financial markets, everything is relative. And so on the flip side of the Fed, there is other central banks, and there is what the dollar does against other currencies based on what the spread between the Fed and those other central banks looks like. So needless to say, it makes sense to take a look at what the other side of the ledger is doing when it does stuff. And doing stuff is exactly what we are going to see here, because the next big part of the macro story here over the next 24 hours is going to be a monetary policy announcement from the ECB, the European Central Bank. So what we are going to do here is take a look at what that looks like, take a look at how the markets have onboarded the information from the Fed and from the ECB into price action, where there might be an interesting trade setup in the euro from here, and how it might get catalyzed by this very ECB meeting. So let's start here with a look at what the euro has done and why it's been doing it. Needless to say, there's a pretty precipitous decline here, all the way down into lows that we hadn't seen since May of 2022, near the 103 figure there. That's this rapid slide from the second half of September into the second half of November. And the story here really has nothing to do with Europe or with the euro as such. It is a story about the US dollar getting stronger. And why it was getting stronger surely is of no surprise to anyone at this point. It is what happened after the Fed started cutting rates in September. The Fed delivered, of course, we now all know, a 50 basis point rate cut, and then said it would do another 150 basis points to follow, 50 more in the calendar year 2024, 100 basis points in 2025. The markets looked at all of that dovish posturing and said, right, so the economy is not weak. Growth is running, give or take, in the vicinity of 3%. At least it's running closer to 3% than it is to 2%. So you're not going to be able to do all of these rate cuts next year, because as you start cutting with this kind of vigor now, what you'll do is lift inflation expectations and reflate the economy. So we're not going to see this many rate cuts out of you next year. And that's a trade that developed in markets, so-called reflation trade, as I've taken to calling it, for the better part of 3 months. You see it here. So on top is the 5-year and the 10-year break-even rates. These are inflation expectations for the U.S. as derived from bond markets. This is the spread between nominal and real rates. And of course, to get from nominal to real, you have to subtract inflation expectations from the nominal. So if you then subtract from the nominal the real, you end up with what that inflation adjustment is. That's what these are. You can see that from September, inflation expectations are rising as you get the sense that the Fed is overstretching on the dovish side of the ledger. Once the Fed is out of the way with their policy announcement, because indeed you can see the markets are front running this, they get into the top of the inflation expectations range before the Fed even pulls the trigger. But once they do, you see an upshift in bond yields. Interesting, of course, and maybe counterintuitive for an environment where the central bank is cutting rates, not hiking them. But of course, markets are forward looking. They don't trade on what is, they trade on what they expect will be. And the question that the market is always asking is, what have you done for me lately? So we have, in response to what the Fed does, not a decline, but a rise in yields, a rise in the US dollar, and a flip for the yield curve from inverted to positive. That, of course, runs until about the end of November, about the second half of November, where we can see inflation expectations anchor and start to even come in a little bit. The dollar anchors, starts to come in a little bit. Yields anchor, start to come in a little bit. That's this bottom right here, where we set this big spike low and then come back up, and now we're digesting into some sort of a range. And of course, the question is, well, does this now open the door for the next leg down, or might we have a bounce here? And that's what we're going to look for in this conversation at trying to figure out. Now, the situation in Europe is dire and growing more so by the day. So it's interesting to look for a euro here that's holding up, frankly, as well as it is. Because if we were trading euros on the basis of what's going on in Europe, that might be giving us a euro that is much lower than it is currently. Indeed, we can see economic growth in Europe is back to recession-like conditions. The latest numbers from S&P Global on the Purchasing Manager Index, which is a sort of timelier version of looking at the business cycle than perpetually lagged GDP numbers, the latest for November gives us contraction. As ever, these numbers are centered around 50, where that's neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. What we have here is accelerating contraction. So we slipped back under 50. This would-be rebound from the recession-like conditions that we saw at the tail end of last year. That has now fizzled. We have the weakest performance for Eurozone economic activity growth since January. All of the positive vibes that were there in the earlier part of the year, now basically out the window. And that's because the service sector is now shrinking. It was offsetting this anemic situation in manufacturing going all the way back to 2022. No longer. Everything is shrinking at the same time now. So from a business cycle perspective, Europe is in trouble. It also doesn't help that we have the return, albeit nominally, of credit risk. This is the spread between German and French 10-year bond yields. And what you see is, for France, we are now looking at the highest, or at least we were about a day or two ago, this is where we've spiked up to, the highest spread, the widest one, on French debt relative to Germany since back here in 2022. That's, of course, the tail end of the Eurozone debt crisis. So what's going on here? Well, we had that snap election that President Emmanuel Macron called. He lost his legislative majority. We now have him governing with a minority government. That minority government attempted to pass a budget. It couldn't do it. That left that led to the collapse of the government. The opposition, right and left, joined forces to essentially vote for no confidence in the government, and it's unraveled. So now we don't have a budget. And the response from markets is, of course, to build in additional sovereign risk into French yields. Irony of ironies, French yields relative to German ones, which are the kind of regional fiscal probity benchmark, the French ones are now at the same level as Greek ones. Now, that's not just because French yield spreads are up, it's because Greek yield spreads are down. And in fact, contagion around the Eurozone is not evident at the moment. The spreads for Italy are down relative to Germany, spreads for Spain, spreads for Greece, as we've just mentioned. All of that is down. So this is not a widespread situation, but it's also a growing divergence in fiscal health at the heart of Europe. France and Germany are the biggest economies. They are the essential axis that is the indispensable core of the entire European Union experience, going all the way back to the construction post-World War II. The entire artifice is really a French effort to prevent back-to-back situations where Germany comes across the French border and burns down everything in sight. So, as of course happened with World War I and World War II. So, when you get this kind of instability at the very core, the very foundation of the euro, it's of course not encouraging and presents significant risks. As if to add insult to injury, through all of this, weak growth and the returning sort of preliminary rumbles of debt concerns, inflation expectations are actually up. If you look at what's been happening here basically since October, November, the German bond market, the break even for the shorter terms there, is telling you that actually inflation expectations have bottomed and are starting to edge up, which is not what you want to see if you are looking for a situation where all of these many headwinds give you a reason for the ECB to start thinking about rate cuts. Because, of course, what you then end up with is a situation where you have basically the central bank's hands tied and unable to act. So, needless to say, it becomes a very important question here, what the ECB will do, since they are, as a matter of fact, meeting within less than 24 hours. So, why are these inflation expectations going up? Well, ostensibly, the problem has to do with energy prices. This is the 1 year forward cost of electricity in the Eurozone as it is transacted on Europe's markets. This is from the European Energy Exchange, or EEX. And what you see here is the rise in energy prices, especially in Germany, right here. Seems to sort of anchor around October and then accelerate higher as we start November. Notice that's basically what we're seeing here. And of course, it's a little bit more muted for France, but the general swings are about the same, and that's really because France is insulated against energy price shocks, unlike Germany, because France still runs a whole bunch of nuclear power. So what to do for the ECB? Well, the expectations here are that the ECB is going to cut rates, and that expectation is pretty well calcified at this point. You're looking here at almost the full move priced in. The probability implied here from 3.25 deposit rate to 3.06 rates by month's end give you the likelihood of a cut at about 76%. So very, very likely that we're going to get this cut. As a matter of fact, the outlook for ECB monetary policy going into this meeting, that's the solid line here, as compared with where we were in October, that meeting, or the one in mid-September, we can see that from January onward, so for next year, the pathway has actually become more dovish. So the markets have made for a flatter curve. If we look at what all of this distills into, we can see there's that 19 basis points being baked in for this meeting, so almost a done deal. And for next year, 115 basis points in cuts on the menu. So let's call it four cuts in the price and about a coin's toss chance for a fifth. So what can the ECB do to really move the needle here? Well, ostensibly, they could look at the growth story and say, woe is me, we need to be cutting rates more aggressively because the economy is unraveling. They could likewise look at this situation and say, well, we know this is not widespread. We know this is only in France so far, but that's worrying enough as is. We could use some lower borrowing costs, or at least the signaling that we are very open-minded to ramping up easing just to check this thing before it runs out of control. And then at the same time, you look at something like this and you say, but inflation expectations are going up. We're going to let this thing out of the bag if we sound too dovish. So what to do? And perhaps the story is nothing. When the markets looked at this, as far as this meeting goes, they've clearly made up their mind. There's going to be a cut. When the markets look at next year, they've already baked in quite a bit of easing. What's going to be market moving or not in this equation is whether the ECB is going to dial up easing expectations further, because surely tightening is nowhere near where the ECB wants to go. So either it is status quo, that is to say the ECB looks at all the various balls it's juggling and goes, you know what, we're going to take it meeting by meeting, we don't know. Wait and see. Or they go, you know what, the rise in inflation expectations is episodic. It's not going to run away. It's just one thing. We'll get through this winter and that will unwind. We've obviously heard the Fed talk a lot about looking through data volatility and looking through shorter term fluctuations. The ECB could certainly make the argument this is one of those things, and by no means is the electricity price situation catastrophic, as we can see here. It got up to the top of its range from May and has receded. So it's tempting to get scared, but maybe not. And so instead, let's focus on the growth side of things. The inflation side of things will be fine, but let's focus on the unraveling of economic growth and give some support there. Well, maybe so. But if you're the ECB, you have a single mandate. That's inflation. And if inflation expectations are rising, maybe you keep your powder dry, as it were. Maybe you don't commit to anything too quickly. And that, given the options, may be a sense of relief for the euro, because given that we haven't fallen for a few weeks now with all of the headwinds facing the euro area and its currency, a lot of the bad news may be discounted already. So all you really need is just a bit of positivity, or at least a lack of further negativity going through major event risk to give you some legs. And the passing of US CPI data over the past 24 hours certainly helps. We can see here the euro has, of course, been tracking German versus US bond yield spreads. This is a proxy for the relationship between the Fed and the ECB outlooks. The 2-year yield is where near-term policy expectations live. This is the US dollar reflation trade right here. This is that trade receding. So we can see German bond yields a little bit less beaten down relative to US counterparts, and so the euro has duly stopped falling. The structure here is one that might look like an inverse head and shoulders pattern, which is a bottom, shoulder, head, shoulder. It's not one until it's confirmed, which would require a close back over 106.29, 106.30 or so. But this might be the line in the sand against which the euro holds. So if you get an ECB that doesn't say much of anything, that is more dovish than where we already stand and what's already been discounted, there might just be enough for the euro to find some relief and say, well, if this is what motivates this exchange rate, and the dollar side of it is basically locked in place after CPI leaves benchmark expectations essentially unbothered, and the next thing is the Fed, which doesn't meet until next week, the euro side is possibly in charge for the next several sessions. And if the story there is less dovish than could have been, less dovish than markets perhaps speculate would come out of the ECB at this meeting with all of the headwinds on the board, the euro may well find its way higher. And if it breaks this level, then the head and shoulders structure would extrapolate a probe back above 108, which could give us an interesting something to work with. And that is macro money for today. As ever, we are here right after overtime, Monday through Thursday. That's a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones later today for the Price of Truth. That's just 30 minutes from now. Definitely come and join as we joust about the future and the appeal of cryptocurrencies, probably yet again. And I'm back with Victor and with Tom for First Call on Sundays at the International Market Open, the Futures Open in the U.S. I'm also opining on the platform formerly known as Twitter, as well as now on Blue Sky at Ilya Spivak, and writing for the news and insights portion of tastylive.com, where this very analysis will be in written form shortly. Thanks very much for joining. Macro Money's back tomorrow.